we've been talking a lot about, where is manufacturing, where is production, and we wanted to start broadly speaking in Asia when we're looking at what is the PMI saying, the Asia Output Index. So we're looking at automobiles, automobile parts, insurance, healthcare services. You're starting to see some of these come lower. So IHS Markit Asia Sector PMI showed broad weakening trends evident across Asian sectors in January. Output falls in 7 sectors, the most since last September. So when you're looking at some of those different shifts, you get an idea of just kind of where some of that slowdown is. And some of it's contraction, some of it is expansion, which is where, again, we fall out with this kind of meandering, kind of small expansion, not this huge, not contraction, but not also this big growth. And when you look at some of the expectations for oil consumption and consumption in general, there's this view that, everything's going to be rip-roaring. Everyone has all this money. But where? Like, whose money are we traveling with? Whose money is being spent? So just look at China for an example. So people made 2.5 million trips during the 7-day New Year holiday. Excuse me, representing 73.9% during the period in 2019 and 2% less versus year over year. Domestic tourism revenue recorded $289.2 billion, down 3.9% year on year, and representing only 56.3% of spending from 2019. So it's not just it's the behemoth in the room that is also weak. It's not just some of the ancillary ones, where some of the ancillary ones, depending on who you pick, will be a bit better. But China has a big slowing problem. And I don't think that's truly appreciated in the market when you're looking at Asian demand and some of the Asian growth, especially Chinese oil consumption. So the Chinese purchases of U.S. goods fell short of trade deal commitments. I don't think that's surprising given where things are. But we're still looking at a range of actions to widen some of the exclusions, because tariffs, we just don't have the ability to absorb some of these tariffs given where prices are, given where inflation is, and you're starting to see some of these shifts. And China's not in a good spot anyway, so how are they going to meet these numbers, which we said back when this was announced, way back when President Trump was in office, that there was zero chance China was going to achieve anywhere near some of these goals. So there's definitely something in terms of where some of these positions are and where some of the underlying growth is going. So then when we look at the EM manufacturing PMI headlines, you get an idea, again, that's kind of bumping along the bottoms. Manufacturing PMIs across the headline index, when you look at Taiwan, Poland, you're seeing a little bit of that trend coming down in January, and how some things are starting to fall underneath on an emerging market level. So the emerging market problems continue and are going to remain as we go through the next few quarters, given, again, cost, price, demand, because as developed markets struggle, so will the emerging markets as you get that knock-on impact. So credit impulses have bounced. They're when you look at the 9-month leaders, they're just above zero or right at zero. And as we were saying, China's looking to protect, not massively stimulate, but protect where some of these pieces are. And we're starting to see this, again, kind of level out in terms of where things sit and where we see this going over the next few months. And it's going to be interesting, and I'll do a deeper dive in terms of what the PBOC is saying, what are some of the commentary. And you're seeing, again, they're willing to support but not stimulate. And I think that's the difference. They're looking to support current levels, but not stimulate, because they don't have the capacity to do so. And there's more and more risk. We had another default announced missed payment on an offshore bond 2 days ago, and that's going to continue to be that pressure point when you look at the maturity schedule. So the China Credit Impulse 12-month net change, that's where their view is that it's going to continue to go up. But again, that credit impulse and the ISM, there's going to be a marriage in the middle. And that's where we see things coming, where there's going to be that marriage, more pressure on ISM new orders as they come back down. But then they're going to level off. And it's going to level off, again, just above 50, just slightly expansionary. But it's going to be under pressure of some companies and people increasing inventories, wholesalers, but retail sales just kind of missing. And again, that's going to be that balancing act of just kind of muddling through some of the first few quarters. This is looking at it from the social financing side. So when you look at the 6 month, things have gotten better. But then when you look at the total, the non-banking loans were the driving force. The total social financing picked up a bit, but total financial loans was flat. And I think that's the underlying problem of where are the loans being generated and who are they going to? And I think that's where they're going to let some of that slide, but they're going to, again, keep pressure on it and, again, kind of pull things down in general. So then when you look at changes in policy rates and reserve requirements, the quarterly report released late Friday cited triple pressures of shrinking demand, supply shocks, and weakening expectations, echoing the sentiment of the Economic Work Conference in December. So they're aware that they have a trifecta of problems. And that's why when you look at support versus stimulus, that's the difference in terms of how much can they actually generate. The report outlined the guiding principles of the monetary support: adequate, well-targeted, and front-loaded. Well-targeted is key because as we talked about last week, 2 weeks ago, small businesses are still getting absolutely crushed, and they're trying to, again, hone in on protecting that small business. So given these signals, the boom in January credit and recent cuts in interest rates and the reserve requirement ratios are probably just the start. But what is the impact? Just because they did it doesn't mean it's having the impact they were hoping for. And so far, we've seen some growth, but we expect it to be a bit more muted because they're coming from where the law of diminishing returns becomes a bigger issue, and they haven't been able to adjust the employment or that financing side. China's growth target for 2022 will reflect a tough reality. The economy is slumping and stimulus will only partially cushion the slowdown. We expect the government to set the goal at around 5.5% based on the provincial targets. That would suggest the government aims to avoid a cliff drop in growth after setting the target at 6% last year, but it would still underline damage from COVID. Even 5.5% growth would be challenging to achieve, which is what we continue to talk about, without considerable policy support. And that's where, how much policy support can they stomach given where debt is, given where rates are, and the fears that remain when you look at the fact that employment is down in manufacturing and services, and then you have an issue in terms of where your industrial production will be at the smallest level. So China of foreign direct investment still remains strong. That's something that has remained a bright spot when you're looking at some of the economic pieces, but the sales slowdown continued. When you look at selected developers, January contracted sales. So when you're looking at some of those developers, you're not seeing the sales, you're seeing those slowdowns, and that's going to put more pressure on their balance sheets because they rely on this to really see some of this growth and to see some of this expansion, which is why there's multiple parts of the economy that continue to shrink, and this is going to be one of those, I think, glaring bright spots, especially when you look at local government financing and other types of provincial growth. China aggregate financing cumulative, just above where we were in 2021. Same with new loans cumulative. That's something that remains a positive when you look at new loans. But then when you look at the shift between money supply, so M1 came down, M2 came up. And you're going to see, again, this push and pull where so far throughout February, they've been taking money out of the system. They're still leaving some liquidity in because, remember, they put a lot of liquidity in for the first month of the year and in front of Lunar New Year. But now you're starting to see this come out, and you're seeing it in money supply M1. Expectations were for 3.2% growth, came in at negative 1.9%. And M2 came in kind of right in line. So again, that mix of where are we going to see the stimulus and through what process. China PPI, again, kind of leveling off, feeding more into that view of, let's call it stagflation, but it's still high, it's still elevated, and we're going to import that. The U.S., the largest buyer of Chinese goods, that's going to be an import and a cost into us. Yes, it's better than expectations, but it's still at over 9%. China's CPI has come down. The survey was at 1%. The actual came in at 0.9. So still a bit better, but expanding. But the bigger issue is core CPI has flatlined. Their goal was to bring down that core, try to support the consumer, and they just haven't been able to do that because of that, again, sticky versus flexible. The sticky side continues to be the underlying problem. Household wealth by asset type. When you look at China continues, the biggest exposure to property, which is why we talk so much about the property indications, and that continues to be an underlying issue. Then when you look at U.S. manufacturing growth is slowing, but not as rapidly as China. So again, one leads the other. We have a symbiotic relationship as much as we may not want to. And it shows how you're going to get this pressure coming that is going to originate from China, and why China is so important when looking at the global backdrop of growth and production and demand. And then non-resident portfolio flows to EM, you can see that there's still some concern on flows into emerging markets. A lot of these concerns reside around where is inflation going to be? What are U.S. rates going to do? 10-year keeps going above 2%, just below 2%. And that's going to be one to watch because the emerging markets price off of the 10-year, which again is an underlying issue. Labor market situation is worsening, and that's an underlying problem that we've been highlighting. The labor issue is not getting better, it's getting worse, which is pushing down consumption, which is a huge pivot point of what Xi is trying to do, is increase consumption, and they're just failing at doing that because there isn't the same job creation and there's not the same job growth, which again is pushing down with the availability and the cash that people can use. Migrant workers continue to slow. Again, all of these things leading to the underlying problems of China's services and business expectations. So a survey for China's services PMI was at 50.5, came in at 51.4. Still, again, a downward move, not as big as it was expected. Again, based on some of the things, it should be lower. So we're going to have to see if there's a bit of a makeup number. But services PMI business expectations are below 60 and getting worse based on, again, small businesses and what we're seeing on that level. How much of it will publicly be announced? That remains an underlying question. Maturity wall, this just shows the pressure that remains as the monthly maturities for Chinese firms struggle. Increase again in March. So February got a bit slower, but March is going to be a really big month, and it doesn't get any better in April or May, which is why we do see a bigger cliff coming, which is why there's that slowdown of how much is being invested into the area. Now, one of the things that we're going to talk about just on the back end of China is Sri Lanka's foreign currency repayments are rising, but its foreign reserves are dwindling. And China has invested in a lot of countries with these dynamics. And that's good. Even though, yes, you can say it's a yuan loan, this is fine. This is a problem. This is an absolute issue when you're looking at the scenarios that we're facing and the problems that are coming up. The foreign reserves are dwindling, which is creating the underlying impacts that are going to, again, drive down some of these issues, which is going to make China take delivery of some of these assets as collateral. But what is their growth? What is their growth profile? So, which is why I keep saying that their debt situation is much worse than at first blush because of situations like this. Then when you look at that shadow banking and shadow financing, again, coming to the non-financial banks, you can see that shadow financing was up year over year. Corporate bonds, again, also going up, but that's the issue. What is driving the increase in loans, and is it what they're trying to do and function with? And that's where you're starting to see some of that flat line on the shadow financing, government bonds. But government bonds were the issue from the beginning. They were trying to cut those, and they're not able to cut them, and they're starting to increase them, even though they were trying to pull down that liquidity, which comes down to where is their situation going to be as we get towards the end of this quarter into next quarter, as Xi looks to try to prop up the economy. Now, South Korea core CPI increased. Survey was for 2.8%, came in at 3%. This is a problem just because South Korea has already raised rates twice. This just means that there's going to be another one. We do expect to see more as they try to counter some of these increases in inflation. Now, the same can be said in India. India's inflation is now back above 6% and breaching the inflation target. They're trying to maintain pricing and some of the subsidies on petrol to avoid some of the inflation. But again, as we've been saying, we expect this inflation to continue to go up and put pressure on emerging market manufacturing PMI and other key pieces, as India is just not able to, and just based on diesel's still down 8% versus 19. Even though India is getting better, it's still not getting back to where it was. And a lot of that is going to be driven based on this sticky amount of struggle in inflation at this point. So then when you look at India industrial production, coming in much better, you're still seeing growth when you're looking at the manufacturing side, but local consumption is kind of that delta on where we're seeing some of those impacts to general growth locally. India merchandise exports, again, remained elevated, which is what I was saying, where imports are up, exports are up. All of that is good. So you're seeing what they're getting it on the export side, but local consumption is where that delta is on what that growth looks like. And without the consumer getting back to normal or at least improving, it's gonna be tough to see them kind of reach the levels that they had on the economic growth side. Again, also weighing on oil demand, oil growth. They're continuing to export that, based on how elevated imports are, that'll support exports, but local consumption continues to be the overarching theme of the problem. And here's CPI coming in slightly above the estimates, and we do expect this to continue to go up by to about 8% as import prices remain elevated. The petrol prices, again, like we did in the EIA show, we said that if Thailand were to keep their current subsidies, it would cost them about $7.3 billion in rising. So these emerging markets that provide subsidies and support for gasoline and diesel still remain an overarching problem in terms of keeping things going forward. Now, when we look at inflation in general, it's also brewing in Japan, and the contribution of mobile telephone fees to the current CPI basket weights, it actually brings it down 2.7%. So as that starts to abate, as that starts to normalize, I think that's where you're going to start to see even some inflation in Japan. So again, a lot of things happening around the world that are very similar, very problematic when you're looking at where are real wages going to go, where's the consumer going to be, and what does overall growth look like in the year of 2022. So if you have any questions, you can find us in the comment section. I'm happy to always talk on Twitter as well, or you can email me directly. Always happy to discuss. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.